The sixth learning objective is to report receivables on the balance sheet and evaluate a company using the acid test ratio, days sales in receivables, and the accounts receivable turnover ratio. As discussed earlier in the text, the balance sheet lists assets in order of liquidity, and that's closeness to cash. Balance sheet data becomes more useful by showing the relationship among assets, liabilities, and revenues. Notice that accounts receivable appear in the current asset section of the balance sheet, net of the allowance for uncollectible accounts. This is the most common method of presentation. Interest receivable is also listed as a current asset, since we expect to collect it in less than a year. Finally, notes receivable is also listed as a current asset, and the note term was 1 year. A more stringent measure of ability to pay current liabilities is the acid test ratio, or the quick ratio. The acid test ratio reveals whether the entity could pay all its current liabilities if they were to become due immediately. The higher the acid test ratio, the more able the business is to pay its current liabilities. What is an acceptable acid test ratio? That depends on the industry. The acid test is calculated as cash plus short-term investments plus net current receivables divided by total current liabilities. After making a credit sale, the next step is to collect the receivable. Days sales in receivables, also called the collection period, indicates how many days it takes to collect the average level of receivables. The number of days in average accounts receivable should be close to the number of days customers are allowed to pay. The shorter the collection period, the more quickly the organization can use its cash. The longer the collection period, the less cash is available for operations. Days sales in receivables can be computed in 2 steps as shown on the following slide. Days sales in receivable is calculated in a 2-step process. Step number 1, days sales is calculated. That is net sales, or total revenues, divided by 365 days a year. In step 2, the average net accounts receivable is divided by 1 day's sales. The accounts receivable turnover ratio measures the number of times the company sells and collects average receivables balance in a year. The higher the ratio, the faster the cash collections. Investors and creditors do not evaluate a company on the basis of 1 or 2 ratios. Instead, they analyze all the information available. When they stand back and ask, what is our overall impression of this company? Ratios serve as benchmarks to see how well a company is managing its receivables. Accounts receivable turnover equals net cash sales divided by average net accounts receivable. Short exercise 8-11 focuses on the reporting of receivables and other accounts in the financial statements. North End Medical Center included the following items in its financial statements. How much net income did North End earn for the month? Service revenue $14,700. minus cost of goods sold, $12,400, and other expenses, gives us net income of $2,300. Show 2 ways North End can report receivables on its classified balance sheet. 2 ways. Current assets, accounts receivable of $25.90 less the allowance for doubtful accounts of $150 gives us net accounts receivable of $24.40. Or accounts receivable net of allowance for uncollectible accounts for $24.40. This exercise addresses using the acid test ratio and days, sales, and receivables to evaluate a company. Southside Clothiers reported the following items at September 30th. Compute Southside's acid test ratio, days, sales, and average receivables for 2012, and accounts receivable turnover ratio. Evaluate each ratio value as strong or weak. Southside sells on terms of net 30. The formula for acid test ratio is cash plus short-term investments plus net current receivables divided by total current liabilities. (1.34) Southside's position is strong. Days, sales, and average accounts receivable. Average net accounts receivable divided by 1 day's sales. The day's sales and average receivables are strong relative to credit terms of net 30. The exercise continues on this page. Accounts receivable turnover ratio. Net sales revenue divided by average net accounts receivable. Southside's accounts receivable turnover ratio is strong relative to credit terms of net 30.